Welcome to North Shore High. I mean, Wall Street. If you've ever been confused about stocks, don't worry. Today, we're breaking it all down in the language of Mean Girls. So listen close, babes. There's a few questions at the end. And yes, they will determine if you can sit with us.
Can't sit with us!
A stock is a piece of ownership in a company. Imagine Regina George. She basically owns the cafeteria, right? Well, when you buy a stock, you're buying a seat at Regina's table. If Regina's having her moment and everyone's obsessed with her, your seat at the table becomes iconic. The company does well and suddenly your stock is worth more. Capital G, glamorous. But if Regina gets exposed for being a fake friend with a burn book, suddenly your table isn't so exclusive anymore. Your stock loses value and it's giving, why did I pay for this seat again? Now that we know what stocks are, let's talk about how Regina's rise and fall actually puts money into your pocket. As I was saying earlier about Regina's glow up, this is how it really works for your wallet. There are two ways to get rich, or at least afford a limited edition pink Prada bag. You bought that seat when Regina was just Regina.
So?
Then she wins prom queen, gets featured in 17 magazine, and suddenly everyone wants to sit there. You sell your seat to the next wannabe for way more than you paid. That profit is called a capital gain. It's basically buy low, sell high, and profit like a plastic. Now, some companies, the classy ones, actually thank you for owning their stock. It's like Regina letting you sit at the table and slipping you $5 every week just to keep the vibe aesthetic, just for being there, just for being that girl. That cash payout, that's dividend. It's giving CEO energy with zero effort. So, where do we even go to buy a piece of the cool table? The stock market is like the ultimate high school hallway. Every company is strutting by in slow motion serving main character energy. Think of it like Fashion Week, but for businesses. Instead of models, it's companies. Instead of outfits, they're showing off their value. You've got the NYSE girls, they're old money. They're the legacy brands. Think Coca-Cola, McDonald's, Gucci energy. Classic, reliable, quiet luxury. The NASDAQ girls, total tech baddies. They've got startups, apps, innovation. Think Apple, Netflix, Google. A little riskier, a little more sparkle, always trending. These aren't just places, they're stock exchanges. Basically, the runways where stocks get bought and sold. When people say the stock market, they usually mean these two girls. They set the tone, the prices, the drama. And just like any high school, it's all about who's hot and who's getting dumped. But like, you can't just walk up and say, I'll take 5 Teslas, please. So, how do you actually buy a stock? A broker is someone or something that helps you buy and sell stocks. Back in the day, it was a real person. Now, it's usually just an app. Think of it like this. Buying stocks without a broker is like trying to buy a Chanel suit straight from the runway. It's not happening. You need someone to make that connection for you. The broker is your personal shopper who brings it out in your size, rings you up, and gives you a receipt. Today, that personal shopper is usually an app like Fidelity or Robinhood. You don't need to know the CEO, you just need an account.
It's like I have ESPN or something.
Now, once you've got stocks, it's time to organize your burn book. I mean portfolio. Your portfolio is basically your closet of stocks. It's not just one cute top, it's your entire wardrobe strategy. A little Chanel, a little Zara, aka some high risk, and some safe bets. Imagine Regina's closet. She's got her designer staples, Apple and Amazon, some trendy pieces, and maybe even a few things she bought on impulse, Dogecoin vibes. Because even if it's designer, you still need variety. Let's talk about how to keep your closet, aka portfolio, from being a fashion disaster. Don't just put all your glam into one Birkin. You don't want everything to be pink.
On Wednesdays, we wear pink.
That's called diversification. Fancy word, iconic strategy. Think of it like this. If you only have mini skirts and it suddenly starts snowing, you're screwed. But if you got sweaters and stilettos, you're ready for any season the market throws at you. A good portfolio equals drama proof. Speaking of drama, volatility is how much a stock's price moves up and down, and how fast it does it. It's basically the mood swings of the stock world. If it's all over the place, it's giving Regina on Caltine bars. 1 second, she's chill. The next, she's throwing the school into chaos. That's a volatile stock. High highs, low lows, and you never know what it's going to do next. On the flip side, some stocks are totally unbothered, just like Karen Smith. Stable, low drama, and always kind of doing the same thing.
Want to do something fun? You want to go to Taco Bell?
That's low volatility. The price barely moves, and you can trust it to stay in its lane. Why does this matter? Because volatility equals risk. More volatility equals more potential reward, but more chances to get burned. Less volatility equals less drama, but less thrill. It's all about knowing your vibe. Okay, let's zoom out and check the mood of the entire school. The stock market? Yeah, she's got mood swings, and we gave them names. Bull market. A bull market is when stock prices are rising. Everyone's investing, and the economy's basically in its booked and busy era.
So, what are we doing this weekend? Yeah, what are we doing? Oh, I have to go to Madison with my parents.
And your portfolio is glowing like it just got a fresh blowout. Investors are feeling themselves, and we love to see it. Think of a bull. It attacks with its horns moving up. Stock market? Same. A bear market happens when stock prices fall by 20% or more from recent highs. And the vibe? Total chaos. Regina just got hit by a bus, the burn book exploded, prices are down, people are panicking, and unemployment is creeping up. Investors are running to safe things like cash or gold. But here's the tea. Bear markets might look scary, but they're not the end of the world. They're a part of the cycle, like a plot twist before the season finale glow up. And bears? They swipe their claws down. Stock market? Same. Bear markets usually happen when the economy is entering a recession, which sounds scary, but if you're a hot girl who knows how to move, it's actually like a major clearance sale on stocks. That means opportunities to get rich while others panic. And trust me, I've got a whole video on how hot girls get rich during recessions. It's the perfect watch for leveling up your money game when things look rough. And you know how Regina made her big entrance? That's basically what companies do when they go public. Time to talk IPOs. An IPO, initial public offering, is like a company's biggest reveal. Think Regina George in slow motion, walking into the Halloween party in that bunny costume. Everyone's watching. Before this, the company was private, owned by founders, investors, and a few early besties. But now, they're going public. They're selling shares, aka little pieces of themselves, to regular investors like you. Why do they do this? To raise money so they can grow? Think new stores, more product drops, and maybe even world domination. And to give their early investors a chance to cash out. Because being early has its perks. It's like they've been planning this outfit for months, and now they're finally walking in to claim their seat at the cool table. Okay, but once they're at the party, how do we actually know how important they are? Like, who's truly the Regina George of the market? Market cap, short for market capitalization, is how much a company is worth in the stock market. It's like a company's popularity score, but with money. The formula is simple. Stock price times number of shares equals market cap. So if a company has a high market cap, that means the public really believes in it. Big market cap is Regina George. We're talking Amazon, Apple, Beyonce level corporate energy. Mid cap is Gretchen Wieners. Still relevant, still cute, trying to make fetch happen.
That is so fetch.
Small cap, Janice Ian. Niche, alternative, but could be totally iconic later, or might dye her hair black and disappear. Different cap sizes come with different risk and reward vibes. Big companies are usually more stable. Smaller ones, more potential for growth and drama. Knowing a company's market cap helps you build a balanced portfolio. You wouldn't only shop at Chanel, right? Okay, maybe. But mixing sizes can help you slay both safely and strategically. So let's say you actually want to invest in one of these girlies. How do you actually do that? Let's say you're trying to buy a vintage miniskirt from the girl in the hallway.
Oh my god, I love your skirt. Where did you get it?
You're like, I'll give you 20. That is your bid. She's like, I want 25. That's her ask. The spread is the $5 in between. It's the tension, the drama, the negotiation. In the stock market, this happens constantly. Buyers and sellers are tossing prices back and forth, like Regina and Cady fighting over Aaron Samuels. When the spread is small, deals happen fast. Boom, miniskirt sold. But when it's wide, nobody's budging. The skirt stays in her closet and you're left refreshing Depop. So, how do you shop smart? Pay attention to the spread. Tight spreads mean you're getting in and out without chaos. Big spreads might be worth waiting or making a stronger move. Okay, so now that you get how the prices are set, let's talk how to actually buy the stock. Because not everyone gets to sit at the table the same way. When you're ready to buy a stock, you've got options, just like shopping in the mall. Market order equals I want it now. Limit order is I'll wait till it's on sale. How you order affects how much you pay and how fast you get your stock. If you want it quick, but maybe more expensive, market order. Want to save money but can wait? Limit order. Want to know how the whole school's doing? Look at this. An index, like the S&P 500, Dow Jones, or NASDAQ, is basically a group chat of top companies. It tracks how a bunch of them are doing all together. Instead of checking every single company, exhausting, an index gives you the group vibe in one scroll. Why do we care? Because indexes are major tea about the economy. If the top companies are thriving, it's giving glow up. If they're struggling, something might be off. Like when your group chat goes quiet and you know someone's about to drop bad news. So how does this even work? Well, each index has its own squad. The S&P 500 tracks 500 of the biggest companies in the US. Basically the varsity team. The Dow Jones, just 30 huge companies, but they've got main character energy. The NASDAQ, tech girlies like Apple, Meta, and Google. Think Silicon Valley in pink heels. So, when people say the market's up today, they're usually talking about one of these indexes doing well. So now we know who's trending on the popularity charts. Let's meet the actual Regina Georges of Wall Street. Blue chip stocks are the ones that have been popular since junior high. Think Coca-Cola, Johnson & Johnson, and Walmart. They've been hot forever. They're reliable, stable, and never accidentally wear army pants and flip-flops just because Cady did.
Saw Cady Heron wearing army pants and flip-flops, so I bought army pants and flip-flops.
They start the trends, babe. They're called blue chip because in poker, blue chips are worth the most. So yeah, it's a flex. Think Regina George level popularity, but without the chaos. They pay dividends, they grow steadily, and they're less likely to ghost you during a market crash. They're not always the most exciting, but they're the ones your rich aunt probably owns. And she's not wrong. Of course, high reward comes with high risk. Every investment has a vibe. Some are chill, some are chaos. This is how it works. Blue chip stocks, safer, lower risk, and steady rewards. New hyped up companies, higher risk, but maybe higher reward. It's like letting Gretchen sing at the talent show. It might be iconic or it might crash and burn. That's why we diversify. Spread your investments around. Protect your energy and your money. Okay, so now that you've got your squad of stocks, how long do you actually keep them around? Investing can be long-term or short-term. It's all about how long you plan to hold a stock. But you might have noticed those last two bubbles are blurred out. Yeah, I see you squinting. Let's just say they're reserved for my future CEOs. If you're not just here to invest, but you're ready to see your last name on a skyscraper, then those words, strategic planning and succession planning, are your new besties. I'm not spilling the tea just yet. I'll break them down in a future video, but only if you're really ready to build your empire, babe. So, if you're interested in seeing that video come to life, drop empire in the comments. Hit subscribe and turn on that bell so you don't miss it when it drops. Now, back to holding stocks. How long is long versus short? Long term is usually 3 or more years, sometimes even decades. Short term is anything under a year, sometimes just days or weeks. Why it matters? Different timelines equal different strategies. Long term is about building wealth slowly and steadily. Short term, it's faster but riskier, and you've got to be on your A game. Long term is like staying friends with Karen, reliable, sweet, she's never starting drama. Short term is like texting your ex because you're bored. Not always a bad move, but it can backfire fast if you're not on your toes. Okay, babe, time to screenshot the receipts. Because if you're gonna invest, you better speak the language. Screenshot this or copy and paste it into your notes from the description below. Before you jump in and buy a stock, just because it's pink, let's find out if you can actually sit with us. Volatility check. Regina George on Caltine bars is the perfect example of low volatility, medium volatility, high volatility. High drama equals high volatility, obviously. Need a broker, babe? How do you actually get one? Slide into a CEO's DMs, download an app like Robinhood or Fidelity, call a traditional brokerage firm, and set up an account over the phone. Download an app, duh. You're buying stocks. What's your vibe? A market order is like snagging the deal instantly at whatever price it's going for, putting a stock in your cart and watching it for 3 days, DMing the CEO first. You're buying now. No games, just gains. Which market screams booked and busy? When the economy's glowing and your portfolio's poppin', that's called a bear market, a bull market. Bull equals good vibes only, babe. IPO equals what now? Initial plastic offering, initial public offering, Instagram profile optimization. It's the company's big debut, main character moment. If you aced that, congrats. Now, you officially know how stocks work, and you didn't even have to join the mathletes.
The limit does not exist. The limit does not exist.
You've got the looks and the money. Wall Street's not ready for you, babe.
Do you agree? What? You think you're really pretty?
If you're still watching, I already know. You're not just watching finance videos for fun, you're building your empire of wealth. And I see you. So, if you're serious about building your empire, drop empire in the comments so I know to make that video next. All about building a long-term wealth, not just quick wins. And if you're ready to take the next step and actually thrive in a recession, hint hint, it's literally happening right now. In 2025, I'd genuinely recommend this next video. It breaks down exactly how hot girls get rich in a recession with the mindset, strategy, and steps to start now. Thanks for watching, and I'll see you in that next video. And remember, if you're investing, you can totally sit with us.